Welcome to Breaking News to Trading Moves. I want you to imagine sitting at an exclusive, high-stakes poker table.
Okay, I am picturing it.
Right, so you have been playing for a while, you have a decent stack of chips, and you are feeling pretty confident.
Naturally.
Yeah, but then the player across from you just looks at their hand, looks at the table, and casually raises the minimum bet to $25 billion.
Oh, wow. That is a quick way to clear the room.
Exactly. I mean, you look at your stack, you look at their absolute mountain of chips, and you realize the entire nature of the game just changed.
Right, because you are now forced to either match that massive bet or, you just have to stand up and leave the table entirely.
Which is exactly what we're looking at with our headline today. Amazon is looking to raise $25 billion through a corporate bond sale.
Right, yeah.
And the proceeds from this massive debt issuance are expected to support their general corporate needs, future capital spending, and paying off older debt maturities.
That poker analogy is actually a really accurate way to frame the current environment.
Really? You think so?
Well, absolutely. Because when you look closely at this headline, it reveals exactly where we are in the artificial intelligence race right now.
Right. It is not just about the tech anymore.
Exactly. It is no longer just about the underlying innovation. It is not just about the math or the algorithms or the software models themselves.
So what is it about?
It is entirely about funding power. I mean, the physical infrastructure required for AI is becoming so remarkably expensive that even the largest, most profitable technology companies on the planet are turning to Wall Street and the debt markets to keep building.
They just don't have enough cash on hand to do it alone.
Right. They're borrowing billions of dollars just to maintain their pace.
Which is exactly why you, the listener, really need to understand the mechanics of this move.
For sure.
I mean, to navigate this market, you have to know exactly which companies benefit from this massive spending and which ones fall behind.
Yeah, it creates a very clear divide.
So let's break down the winners first, starting with the players who have the biggest chip stacks at that poker table.
The ones driving the bets.
Exactly. We are talking about the cloud and AI platform leaders. If you are tracking these, you are looking at Amazon, ticker AMZN,
right.
Microsoft, MSFT, and Alphabet, GOGL.
Now, the reason this specific group benefits is, well, it's pretty straightforward, but it requires understanding why AI is so uniquely expensive.
Because it's not just regular servers anymore, right?
Not at all. Amazon's bond sale proves that the large cloud platforms are investing aggressively in infrastructure, and they are not pulling back.
Yeah, they are doubling down.
Right. Building a modern data center isn't like building a traditional server farm from, 10 years ago.
How so?
Well, you need highly specialized cooling systems because these servers run incredibly hot.
Oh, right, the liquid cooling and all that.
Exactly. And on top of that, you need massive, dedicated power agreements. Sometimes that means building entirely new power substations.
Wow. Just for one facility.
Just for one facility. And you also need the most expensive custom silicon ever manufactured to actually process the data.
So you can't just plug an AI data center into a standard wall outlet.
No, definitely not.
Yeah.
So companies with the biggest cloud businesses, the strongest balance sheets, and the largest customer ecosystems are best positioned to absorb that massive upfront cost.
Because they can actually afford it.
Right. But also because they have the existing customer base required to take those expensive new data centers and convert them into future revenue.
Ah, I see.
Yeah, when Microsoft or Alphabet spends, say, $3 billion on a facility, they don't have to go out and find new customers. The demand is already waiting within their own ecosystem.
Okay, let me make sure I'm following the logic there. Does this mean the battleground for enterprise AI is exclusively locked down by AWS, Azure, and Google Cloud?
Pretty much, yeah.
Are we saying no one else can even afford the buy-in?
Yes. This absolutely keeps the focus on AWS, Azure, and Google Cloud as the central battlegrounds for enterprise AI.
Because of the cost barrier.
Exactly. Building the physical infrastructure required to train and run these models at an enterprise scale requires tens of billions of dollars.
Right.
And very few entities have the capability to deploy that kind of capital continuously without destroying their own balance sheets.
Okay, so if Amazon is going to Wall Street, borrowing $25 billion and immediately writing checks to build these facilities, we really need to ask who exactly is cashing those checks.
Someone is on the receiving end of all that money.
Right. They aren't keeping the money in a vault. They are spending it. That brings us to the casino selling the poker chips, basically.
The hardware and banking winners.
Exactly. The suppliers of the AI chips and infrastructure are the immediate recipients of this capital.
The builders.
Yep, the builders. You are watching Nvidia, ticker NVDA, Broadcom, AVGO, and Advanced Micro Devices, AMD.
Heavy capital spending in the technology sector usually translates directly into massive demand for hardware.
Right. They're buying the physical stuff.
We are talking about the core physical components of the build-out. These companies supply the accelerators, the networking equipment, the custom silicon, and the physical data center hardware itself.
So the logic here is pretty simple then.
It is. If Amazon, Microsoft, and Alphabet keep spending aggressively, the suppliers exposed to these build-outs will continue to see strong order visibility.
Meaning they know the orders are coming.
Right. The pipelines for their products remain completely full.
So as long as the biggest players keep borrowing and spending, Nvidia and Broadcom just keep manufacturing and selling, the orders just keep rolling in.
That is the expectation, yes. However, there is a core question for this group that investors must keep in mind.
Oh, what is the catch?
Well, order visibility is one thing, right? But will this massive spending keep translating into actual recognized revenue growth for the suppliers?
Wait, what do you mean by that? I mean, an order is an order, right?
Not necessarily in the hardware supply chain. Yeah, when Amazon orders a massive cluster of chips, they aren't getting next-day delivery on Prime, you know.
Good point.
There are long lead times. The market will demand to see those orders consistently convert into sustained revenue on the income statement over the coming quarters.
So they want proof.
Exactly.
Right.
They want to see the hardware actually delivered and paid for, not just promised in a backlog somewhere.
That makes a lot of sense. And, you know, speaking of getting paid, we really have to talk about how Amazon gets its hands on $25 billion in the first place.
The debt markets.
Right. They don't just print the bonds themselves and hand them out to random people on the street.
No, that would be chaotic.
Right. They need facilitators. And that brings us to the bankers.
The ones making the deals happen.
Exactly. The facilitators of this debt include JPMorgan Chase, ticker JPM Goldman Sachs, GS, and Morgan Stanley, MS.
You see, large bond sales create immediate and highly lucrative capital markets activity.
It is a huge payday for Wall Street.
Oh, absolutely. When a corporation decides to raise $25 billion, they hire major investment banks to underwrite the debt.
So for the listener, underwriting basically means the bank acts as the middleman, right?
That is exactly what it is.
They take on the risk of pricing the bonds, and then they distribute them to massive institutional investors like pension funds or mutual funds.
Precisely. And for providing that service and taking on that risk, the banks generate substantial underwriting fees.
Which goes straight to their bottom line.
Yep. If big tech continues to tap the debt markets to fund their AI investments, banks with strong debt underwriting and institutional distribution businesses benefit from continued deal flow.
It just keeps the engine running.
Exactly. Furthermore, a successful $25 billion issuance proves that the debt market remains wide open for high-quality corporate issuers.
Because investors are clearly still very willing to lend to them.
Exactly. There is a lot of appetite for that debt.
Okay, so we have the builders thriving and we have the bankers thriving. But this massive capital requirement creates immediate pressure on the rest of the market.
It absolutely does.
Let's go back to our poker table. If the minimum bet is now $25 billion, who is getting blinded out of the game?
The smaller players.
Right. Let's look at the squeeze challengers and the high capex losers.
Okay, let's break that down.
So the challengers feeling the pressure are the smaller cloud and software companies. The companies to watch here are Oracle, ticker ORCL, Snowflake, SNOW, and Datadog, DDOG.
The primary reason this group feels pressure is the sheer capital intensity of the AI race we just described earlier.
Because they can't match the spending.
Exactly. As the cost of participating rises, smaller or, less cash-rich technology companies find it increasingly difficult to compete directly with Amazon, Microsoft, Alphabet, and Meta.
Just don't have the war chests.
Right. They simply do not have the same financial firepower.
I mean, in the old days, a software company just wrote great code, hosted it on a standard server, and enjoyed incredible profit margins.
Those were the good old days for software margins.
Yeah, but AI requires enormous raw compute power every single time a user asks the software a question.
Exactly. The cost of goods sold is entirely different now.
The overhead is massive.
Right. Consequently, investors are asking a very pointed question right now.
Which is?
Which software companies can actually benefit from AI demand without needing massive balance sheet commitments?
Right, because if Oracle or Snowflake tries to match Amazon's spending.
They would completely wreck their own balance sheets. I mean, they would take on way too much debt.
Yeah.
If a company has to borrow heavily just to stay relevant, the market starts to view them as a much riskier proposition compared to the mega caps who can absorb those costs easily.
That scrutiny on spending leads us directly to the high CapEx losers.
Capital expenditures are definitely under a microscope right now.
Right, CapEx is the metric to watch. The technology names that could face pressure here include Meta Platforms, ticker META, Tesla, TSLA, and Palantir PLTR.
Amazon's bond sale highlights a wider concern across the market regarding these high CapEx names.
Because they spend so much.
Right. AI growth requires very large, repeated investments long before the financial returns become clear.
It takes years to see the payoff.
Yes, and stocks that are currently priced for major upside face intense scrutiny regarding their debt levels, their free cash flow, and their return on invested capital.
Investors want to see the math.
Exactly. The market mechanism here is strict. The market may reward the clear AI leaders, but it punishes companies where spending rises faster than visible profit.
Okay, wait, I have to challenge you on that point.
Go for it.
Aren't these highly successful companies? I mean, we are talking about Meta and Tesla. Zuckerberg pivoted hard to AI, and investors rewarded him for it. Meta just posted incredible ad revenue.
They did, yes.
And Tesla has massive retail backing and dominates the electric vehicle space. Doesn't Wall Street usually give these specific founders a blank check for research and development? Why would this time be any different?
Well, you are absolutely correct that they are immensely successful companies. But historical success is not the issue at hand here.
So what is the issue?
The issue is the math behind how capital expenditures affect earnings.
Okay, explain that for me.
When Meta buys $1 billion worth of servers, they don't just expense it all on day one. They depreciate that equipment over several years.
Ah, right, accounting rules.
Exactly. That means for the next 4 or 5 years, their earnings are taking a heavy hit every single quarter.
Oh, so the depreciation drags down their reported earnings per share.
Exactly. And the stock market is a forward-looking discounting mechanism. When a company is valued highly, it is because investors expect strong future cash flows.
Right, they are paying for tomorrow's profits.
Yes, and if those future cash flows are delayed or compressed because the company has to continually reinvest billions just to maintain its competitive position in AI, well, investors revise their financial models.
The math changes.
The focus turns entirely to return on invested capital. A successful company can still see its stock price punished if the cost of maintaining that success becomes too burdensome.
Because free cash flow is ultimately what drives valuations.
Exactly.
Well, that scrutiny on spending and borrowing leads directly to the broader software ecosystem and how those companies are valued.
The rate-sensitive names.
Exactly. That brings us to the rate-sensitive stocks. The valuation victims in this scenario include Salesforce, ticker CRM, ServiceNow, NOW, and Adobe, ADBE.
The mechanism impacting this group is closely tied to the bond markets.
Because of interest rates.
Right. If more large companies issue debt to fund their AI ambitions, it pulls liquidity out of the system.
Meaning there is less cash to go around.
Yes. Investors naturally pay closer attention to borrowing costs across the entire sector. They scrutinize valuation multiples and future cash flow assumptions much more rigorously.
Which hurts the software companies.
Because the companies you mentioned are often classified as long-duration growth stocks.
Let's define that for a second.
Sure.
For you listening, a long-duration stock basically means a company whose biggest profits are promised many years down the road. It's similar to a long-term bond.
That's a great way to describe it.
Yeah, a large portion of their expected value is based on cash flows that won't actually happen for 5, 10, or 15 years.
Precisely. And long-duration growth stocks become exceptionally vulnerable when the market begins to question how much future growth is already priced into the current stock price.
Right.
If the yield on a corporate bond goes up because the market is flooded with new debt from Amazon, investors have a choice.
Right. The investor asks themselves, do I take a guaranteed safe yield from Amazon's newly issued bond today, or do I risk my money on Salesforce's promised earnings in the year 2030?
Exactly. It becomes a comparison of risk. And because borrowing costs go up, the present value of those distant future cash flows goes down.
It hurts the current stock price.
It does. It does not mean these companies are weak businesses.
Yeah.
I mean, they have incredibly strong recurring revenue models and great software.
But the valuation is tricky.
Exactly. It simply means the financial math for achieving AI-driven upside in their stock prices is getting harder to justify.
They need to deliver now.
The market requires more proof of near-term execution rather than relying on promises of distant future dominance.
You know, you described a timeline earlier that really clarifies this entire situation. Can you explain the 3 phases of the AI cycle and how this news fits into that progression?
Certainly. Amazon's $25 billion bond sale is a loud signal that the AI cycle is entering a much more expensive, demanding phase.
So what was the first phase?
The first phase of the trade was entirely about excitement. It was driven by the initial realization of what generative AI could accomplish, and valuations expanded rapidly based on potential alone.
People were just throwing money at the concept, the classic hype phase.
Yes, everyone wanted in. The second phase, which we are deeply embedded in right now, is infrastructure.
The physical build-out.
Right. It is the physical heavy lifting, the build-out of data centers, the procurement of specialized chips, and the massive capital raises required to fund it all.
And the next phase. What comes after the building is done?
The next phase may very well be discipline.
Discipline. Okay.
Yeah, after the excitement and the infrastructure spending, the market will demand to see the financial returns. Investors will want to see the actual math proving that all these borrowed billions were worth the effort.
Which leaves us with a final thought to consider.
It all comes back to the poker table.
Exactly. If the minimum bet at the poker table keeps rising, what happens to the players who are all in but have terrible hands?
They get wiped out.
Yeah, it's one thing to borrow $25 billion if you have the enterprise customers of Amazon or Microsoft waiting to buy your compute power.
Right. You have the demand lined up.
But there are dozens of companies out there masking poor core business performance behind the disguise of AI investment.
Oh, absolutely. We see it all the time.
When Wall Street eventually demands to see the profit from those investments, the fallout for those specific companies could be brutal.
That brings us to the essential questions moving forward. As you look across your portfolio, you have to ask, who can actually fund AI?
Who can afford it?
Who can monetize it? Who can defend their profit margins while simultaneously spending heavily on new technology?
That is the big one.
And perhaps most importantly, who is just adding operational cost without generating enough return?
The metrics are definitely changing.
They are. Those are the precise metrics that matter now. That is exactly where the market will start separating the real durable winners from the very crowded field of AI names.
The pretenders get left behind.
Exactly. This specific news item keeps Amazon firmly at the center of the AI infrastructure story, but it also applies immediate pressure on the entire supply chain and software ecosystem.
Because everyone feels the heat.
Watch the cloud names to see if they maintain their market share. Watch the chip suppliers to verify their order visibility actually turns into recognized revenue.
Not just promises.
Right. Watch the data center stocks as the physical footprint expands. And watch the banks to gauge the health of corporate debt markets.
Keep an eye on the money flowing.
Above all, watch whether investors continue to blindly reward capital spending, or if they start aggressively demanding proof of returns.
The era of free passes on AI spending is coming to a close.
I completely agree.
As you navigate these markets, ask yourself if the companies you follow are the ones building the infrastructure, financing the infrastructure, or just struggling to pay the entry fee. This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.